was not a setup. Here's a K1 form right here. All right. XYZ Services, remember we saw that before. Now, here's what we saw on there with the $147,200 of income. It comes from line, and in your handout, I'm sorry, in your handout, we're on page 7. $27,200 of profit from the LLC gets passed through to him. $120,000 in guaranteed payments gets passed through to him. Now, a guaranteed payment is similar to salary that an LLC member or a partnership is going, or a partnership owner is going to get. All right. This, basically, all of these numbers right here are what adds up to go on to the Schedule E. So he's taxed on $147,200. Now, this guaranteed payment, he's not going to get a W-2 for it. He's not going to get a 1099 for it. But here it is right here. I get a lot of questions about guaranteed payments on the website, like I was saying earlier. People want to know. This is where it comes from. This is the only place it's reported, and this is and so it adds in to any profit that gets allocated. In this case, you'll see this guy's an 80% owner right here. So 80% of the LLC's profit got allocated to him, which is $27,000. Plus the 120, so there's your 147.2. But distributions, he actually received $48,000 in distributions. All right, so some of you probably, I've used this K1 in several seminars before. Some of you may know the answer, but what's his real income? What's his cash money income? Is it 147.2, or is it 168,000? Okay, it's 168. He got the guaranteed payment. He got checks for this, the guaranteed payments, and he actually got a check, let's say at the end of the year. That's a bonus, so to speak. That's a distribution of profits. So even though he only had to claim $27,200 in profits, he actually received a $48,000 distribution. So his income for, arguably his income for support purposes is $168,000. All right, but this question, every time Darrell Blanton's in the audience, he always says, well, wait a minute, Rob, well, what about if he's taking distributions of $48,000, what if he put in $30,000 during the year? Or what if he put in $30,000 at the end of last year and he's just paying himself back some of that? That's a legitimate argument. And so let's say, that's a 2010 K1, let's say he did put in $30,000 in November of 2009 to help capitalize it, and now he's paying back $48,000. He's got a legitimate argument that, hey, I'm just paying I basically loaned the company $30,000 and I'm paying it back to myself. So only $18,000 of that 48 should be really supported. And I think that's a legitimate. And if you're on the other side, you're going to want to make that argument. So look for capital contributions and capital withdrawals, and this is a capital withdrawal right here. Did that answer your question basically?
Yeah. A lot of times there's no guaranteed payment out there. You're just looking at your ordinary business income. You might not take that at all. It's still stuck inside the business, so you don't get a check.
Well, yeah, and that's another classic forensic accounting application is to look at the retained earnings of the business. Right, and it's something like that it's assuming they have some legitimate accounting going on there, or a legitimate accountant preparing their tax returns. That should be fairly easy to determine. Because if they made profits of $100,000 and they only paid themselves out $48,000, well then they're retaining. There may be legitimate reasons to retain working capital like that, or there may not. If they've never done that before, they've always paid their profits out. Let's say they've always paid 100% of their profits out, clear out the bank account. But in the year of divorce, he just changed the policy on that. Well, which I see that once or twice. And so that's obviously, if you're the wife's, attorney, you're arguing, hey, man, you changed the policy, that's BS, you're retaining earnings in the business, distribute those out. I think we actually have some case law on that, on retaining earnings, and that you can, I think, correct me if I'm wrong, if anybody knows, I think you can take some of those retained earnings and add that into their actual supportable income. Their earned income, if they are retaining them. You're certainly going to want to make that argument, if you're the wife's attorney. Here's your W-2. I'm not going to go through that now. Lucy, how long do I have until 11:40? Oh, good. There's 10 more minutes than I thought. Okay. Now, this is from an actual case. This is a very complicated. This guy was a day trader, and he had a whole bunch of different accounts. I think he ended up having about $350 million worth of trades during the year. And so, of course, that just dazzles the wife, and you're like, oh my God, $350 million. Well, the guy actually ended up losing a couple $100,000 that year. Just because he traded $300 million doesn't mean that he made $300 million. And so, what I want to show you on this particular statement, there's a lot of information on here, and some of it will deceive you, perhaps. And what you're looking at here, this is a December statement, and the statements basically, they turn over. You get one every month, but a lot of this information sort of zeroes out at the end of the year and turns over and becomes, January 1 becomes, new information. So what you're looking at here, these are all the transactions that occurred during the month of December. And in your handout, you're on page 8. This is what occurred during the period. It says this period. And then this is year to date. This is what happened. It's a calendar year, so from January 1 through December 31, this is what all happened in this account. All right. So he started off the year, January 1, with $1,286,000. Let's see, cash value purchases. Okay. He purchased $319,000 of assets. He sold $319,000 of stocks during the year. It appears that he took out $34,000. He drew out $34,000, but you might say, well, look, if he drew out $180,000 in December, why does this only say $34,000 year to date? Well, because he actually put some money in too in some other month, and that's why you've got to get every single month of a brokerage account or a bank statement. You got to get every single month. So if there's one missing, you need to get it, because usually there's a reason that one is missing. If they just happen to forget November of 2007, well, that's when he happened to file. Oh, he just happened to forget that month. Well, make sure you get every single month, because if you don't, this one statement from December is not going to tell us. If he took out 180 in December, it says withdrawal, and brackets mean negative. That means a withdrawal. Okay, so brackets means it comes out of the balance. So he must have, if the year to date's $34,000, in December he took out 180. That means he had to put in at least 150 at some other time. Does that make sense? The point of this is that you got to get every single month, and you got to go to every single month and see what the transactions were. Not necessarily all the buys and sells of all the stocks and bonds and options and whatever. What you really want to know is money that went in, money that came out, the transfer of, in this case, $461,000 got transferred in from another account. So you had $461,000 worth of stocks and bonds that came in from some other account that just got journalized over. That's what that means. And he lost $686,000 during the year in value. The actual prices per share in his trades that he made, he actually lost $600,000 during this year. So, and I'm going to show you where some of these numbers come from. So bottom line is, at the end of the year, at 12/31/08, he has $1,031,000 left. So this is just basically a formula. It's A, it's A plus B minus C minus D, and on down the line equals ending balance. Okay, but this is year to date. So these numbers occurred all throughout the calendar year, and I'm going to show you a couple of those. Oh, here's something of note. This is a 32-page document, but I've cut a lot of it out. On this page, it just shows margin loan information. So this is a marginable account. Some of these, he could have a loan on it. You need to know that. He could. He has $659,000 he can actually draw out, but he can buy up to $2 million worth of other stocks, even though he's only got $1 million in it. Remember, he's $1,039,000 in it. He can buy up to $2 million worth of stocks on margin. He can borrow it and then leverage out his borrowing. So, but in this particular case, he did not have a margin loan. It said it was a zero balance. I'm sorry, I'm messing this up here. And then here's some transactions. I'm not going to go through what all the actually these are the balances of what he has at the end of the year. I'm not going to go through all that. What I do want to show you is buried down. And here's some realized gains and losses, all his buys and sells. It ends up being about 10 pages worth of it just for December. This is just December. He had 10 pages of transactions. Yeah, down here buried on page 28 of 32, here's that deposits and withdrawals section. All right. I always want to look at that. We got lucky on this particular case. I had about 20 accounts over 5 or 6 years I had to go through, because every month he had 5 or 6 or 7 transactions where he's got $100,000 going in, coming out, going in, coming out. But fortunately, this Schwab statement told us what accounts it was going to or coming from. He had a SunTrust account, bank account that was tied into this. So if it was a SunTrust number that I recognized, I didn't go track that down. But there were a whole bunch of these back in 07 and 09 where I didn't recognize where it came from. We actually had one of those, foreign futures deposits, like I was joking about earlier. He actually had a foreign deposit that came in. And so, we're like, well, what's that? Oh, that was that stock option I exercised in 2000. His employer was a German-based company, and he kind of forgotten about, well, what happened to that stock option money you exercised? Well, we were able to trace it down, and so they did have a foreign account. I mean, it proved that he did, and so that wasn't good for him. But you can see this is buried down on page 28, the deposits and withdrawals. And the rest of this is just basically giving us balances of various things. And it was 32 pages long. All right. Now, once again, I'm moving quickly. Stop me if you have any questions. On your handout, we are now on page 12. And another hot issue, and one of my survey issues that people told me they wanted to know more about, were government pensions, whether it be a teacher, that's the TCRS, Tennessee Consolidated, whatever it is, retirement system, or in this particular case, I've got 2 persons that were employees, civilian employees of a branch of the government, or rather, branch of the military. Husband and wife both worked there. You can probably figure out what it was if it's in the Memphis area. And the wife had worked there probably 10 years before the husband. She had a different plan, because in the mid '80s they changed the federal government changed their civilian retirement plans. So the wife had a CSRS, Civil Service Retirement Service, I guess. And the husband had the FERS plan, the Federal Employee Retirement System. Very different. The wife's was much more had much more contributed to it. It had a lot greater value, but she didn't get Social Security, or wasn't going to get Social Security. But under the FERS plan, they do get Social Security. So it's a combination of Social Security and government pension. So what this particular page is right here is, I'm sorry, I don't have this on PowerPoint. That's why it's screwing up. It's on a PDF. I apologize. What we have here is this is one of my forms. This is a typical present value calculation I might do on a pension plan, and it was important that we did this. These folks got divorced in 2005. Court retained jurisdiction until they both retired. I don't know exactly why, but then they wanted to know, okay, what are the pensions worth? Now, once we retire, we know what everybody's going to get. But that didn't make sense to me, because what we needed to do was present value it back to 2005 to see what the values were in 2005. That's when they got divorced. They didn't get divorced in 2010 or 2011. They got divorced in 2005. So why they didn't just go ahead and present value it back in 2005, I don't know. And present valuing, if you don't know this, on a defined benefit plan, defined benefit is one of those plans where you get a monthly payment for life, that kind of once you retire. All right, well, we can present value that and tell you what the lump sum equivalent value is today. It's a hypothetical value because you can't get it, but if one spouse says, you're not going to touch my pension once I start drawing it, okay, we'll present value it to today, and then maybe the wife gets something else, like the house. It's called offset. Everybody knows what offset is.